Hello everyone. So welcome to the first educational video of my tenure at Spitfire Traders. So you may have seen the disclaimer here. Just make sure you give that a good read. Pause the video right now. Um, Quite important. Um, cool little side note. What's happening right now? I've got a trade open on my 100k New York account. Currently trailing stops. The profit's sat right now at around $1,000. I'm just going to let that play out, let that trail. This idea is quite advanced. I'm not going to be going over that kind of stuff today, so I'm just going to hop straight into the content. Right, so just a quick introduction about me. So I started out in Forex, learned trend lines, EMAs, fibs. I took that to gold, oil, and eventually Bitcoin and altcoins, where I eventually started to see a return. From there, I began to learn various concepts like high time frame closes, order flow, volume profiles, naked point controls, order blocks, etc. I never quite settled on one. I'd use various confluence to tell me why a level must work. There's so much confluence, like, right, why it must work. But when I entered, I'd either get in too early, I'd get swept before the move, or the level would fail entirely. A lot of you probably experienced this. Obviously, I'm not as familiar with Spitfire because I have quite new to the community. Obviously, things may be different, but for me, what I experienced was I was an analyst, so I could give you 50 reasons why other highs and lows worked perfectly, but I couldn't execute effectively and consistently in a live market. I was not a trader. I understood risk management. I had been through years of experience in the market and was just looking for that one breakthrough where it all clicked for me. So how the hell was I going to fix it? Because I'd come too far and mama didn't raise no quitter. So there was always something missing, I felt. I wanted mechanical rules for entry. If this, then do that. I wanted a strategy with probabilities. These were things that eluded me in crypto. And upon a lot of reflection over the best part of 4 years, I realized all the money I made in spot was largely lost gambling in futures, trying to get rich fast in major bull/bear markets. And I went up and I went down with them all in the past 4 years. Uh, and not really trading with a plan. Like something had to change. So then around 2 years ago, I found prop firms and CME futures. I took this as a chance to apply a new strategy to a new market. So I went for market structure initially. Like I said, I was looking for something mechanical. I wanted rules for a trade, entry models. I wanted to simplify as much as possible. Focus solely on the candlesticks and nothing else. And I found success doing this. I finally felt like I could actually see where the market was headed, but it still wasn't quite clicking for me. And I had one more gap to fill: liquidity. It was a common theme across my entire trading career. I couldn't see the liquidity. So I was the liquidity. Once I begun down this next path, it all truly clicked. So, first thing I want to do is quickly just do a little like pro con for crypto versus equities and why I made the switch primarily and why I truly to this day still believe it's if you want to make a long term like consistent career as a trader and come here every single day and trade, then equities is far more fruitful than crypto on a day-to-day basis. One of the reasons is there's shorter time windows, you get the weekends off, you get the evenings off. There's not any trading going on while you're asleep necessarily, and there's timed volatility. The market tends to pick up at specific points of time. So not only that, but I see a lot more technical behavior, just the way I read the market personally. Obviously, everybody's got different strategies, and I'm not trying to put anybody else's down or say my strategies are better. I just know these work for me. And at the end of the day, it's down to you to decide whether this is something that resonates with you and whether it's something that you're able to actually use and apply and see the results from and can follow through with over the long term consistently. So another factor of equities is there is higher liquidity and there's larger intraday swings and opportunities. So like during the London session, you can be trading for a couple of hours, sometimes less than an hour, and you can get a huge opportunity, a great trade. And not a lot of crypto provides that. And the dramatic explosions in price action can be pretty random. But anyway, I could go on about that subject all day, but I've got a lot of ground to cover here. The point of this session is to give you the foundational bedrock of how to actually understand the concepts I'm using and how to actually engage with me during trading sessions and trading rooms, because I do 2 of them a week on a Monday and a Wednesday. So what I'm going to do is just first of all start off with what is a prop firm, what is the prop firm I use, how do you actually understand the chart data. So here I've got a nice little graphic that I'll quickly explain. Hold on 1 second. So I personally use Topstep. Why? Well, simply because it has the least rules. That's a matter of fact. It has the least rules, and it's the best platform with the best tools, and they offer a really, really simple like payout process, very quick as well. Like if I get a payout secured, I can get the money in my bank within 48 hours. So that's my main reason. So the way it tends to work is you get like a 50k account, and with that 50k, you have to make 3k in profits. You have to turn 50 into 53. Then you pass your evaluation. Once you pass your evaluation, you then get offered a funded account. You then pay $150 for that funded account, so $200 in total to go from evaluation to funded. And then once you get to the funded account, you just have to accrue 5 total days or 5 total winning days. And a winning day is defined as $200, and they do not have to be consecutive. Okay, so you could trade for 20 days and just 5 of those could accrue 200, and you at that point be able to withdraw 50% of your balance. And you'll get 100% of your withdrawals up until the 10k mark. Once you hit 30 winning days total, you can withdraw the entire balance. So with an XFA, you start off with a 0 balance, but you have 50k in purchasing power or margin. The way to leverage this, and what I do, is I have 5 accounts where I use a copy trader. So if I take a trade on one account, it's automatically copied across another 4. So I'm effectively trading with 5x leverage. So if I make $200 on one account, in reality, I actually just made 1,000. So that's how the evaluation and the funded accounts kind of work. But this next section is more about like the actual ticker or the actual like asset itself as it trades on TradingView. So as you can see, we've got price as you normally see on the side. So this is currently the mini, so the E-mini, and it's important that you're on the CME. Okay, so you can see CME and you can see E-mini, right? NASDAQ. There is the NQ and the MNQ. All right, so the MNQ is the micro. So this is how that works. The mini is 1 to 10 micros. Okay, so for every 1 mini, there is 10 micros. Okay, 10 micros equals 1 mini. Okay, what is referred to as a tick is 0.25 in price. So here you can see if I pull from here to here, it's gone from 704.5 to 874.5. That is 681 ticks or 170 points. Okay, 4 ticks equals 1 point. All right, don't have to worry about that too much. Once you start actually getting into like trading and actually taking trades on maybe a practice account or an evaluation account, this stuff becomes just so obvious, and this is just the very, very fundamental basic of actually where price moves. So if you've got, or how price moves, so you've got, let's say for instance you're in a long position with 1 mini and price went up 200 ticks, that would equal $1,000 in profits, because for every 1 mini it is $5 of profit per tick. Okay, so it'd be the same if it was 10 micros, it'd be $5 per tick. If it was 5 micros, it'd be $2.5 per tick. Okay, all the way down to 1 micro, which is the smallest position size you can use, which would be 50 cents per tick. All right, so that's just the very, very basics of, you know, what you're looking at right now. Okay, now we can start to get into the fun stuff. Yes, this is being recorded, mate, so you'll be able to see it later, don't worry. So there is, like I said, there's quite a lot of ground to cover here. So I'm just going to quickly just show you this, my document here. The basic foundational content we're going to cover here, I'm just going to quickly go over this disclaimer. These are not ICT concepts. They are liquidity concepts. Fuck that boring old guy. I've never watched any of his videos, and I'm not interested in engaging with his cult. It may seem online that most of this stuff is some sort of ICT concept, and I get why people have an aversion to it, but it's like if I used a chair and I said this is called Cake's ass support, and then claimed ownership and credit for it from anyone who's used the chair as using my invention, Cake's ass support. The world doesn't work like that. Just because you use something, apply it in your own way, doesn't make it yours. There are many names, terms which you may already be familiar with from Spitty, from other people, from anyone, but the underlying concepts are effectively the same. Okay. So there will be time for questions. So I'm just gonna rumble on through and get your questions as I go, and I'll refer back to them when I can. Okay, so starting off, FVGs, or as ICT gobshites call them, fair value gaps. I just refer to them as gaps. All right. So simply, this is a 3-candle structure, right? So you have candle one, you have candle 2, and you have candle 3. All right. The body of candle 2 is what we refer to as the gap. Okay. So as you can see, you've got a candle here with a wick low. Have a body that creates this void, this gap, using the body, and then the bottom of the gap is used as the wick high of the 3rd candle. All right. Highly recommend not using any indicators that point these things out for you, because you'll see a lot of noise in price, and what I'm going to show you is how to reduce the noise and how to find the most important gaps, because it's really, really important that you're able to actually train your eye and program your brain to be able to spot these, because it will serve you a lot better in the long run. So what I love the most about these gaps is that they represent liquidity. All right. So the gap itself represents internal liquidity, which you may not be familiar with. The high and the low. So the high of gap one, candle 1 there, and the low of candle 3 there, they in this example are the external range high and low. Now this may be different, so if we just look at a quick example on here, like for instance, here's some internal liquidity right there. For me, that would probably be the external high, and that would be the external low. It's not quite precise, but you're just looking for, like, where's the pivot high, where's the pivot low. Okay, so it's not always going to marry up with 1, 2, 3 candles, but what you're essentially looking for is where is the wick, the pivot high, where is the pivot low, where is the internal liquidity. All right. So in terms of liquidity, the market tends to move from internal to external in a constant cycle, backwards and forth, back and forth, backwards and forwards. So it goes from internal to external, from external to internal, from internal to external. This is the fundamental nature of liquidity, and this is where I pretty much base my entire strategy upon. It's this concept of understanding the direction of liquidity, the direction of price. Where is price trying to go? And how am I determining support, resistance? How am I determining which direction, essentially? So gaps identify also a push in the market. So this potentially shows us intention from the market participants, and that allows us to use this data to form trading ideas. Remember that word, okay? Remember the word intention. That's a really, really important word, because I use it a lot, and it's very, very important for when we start getting into the nitty-gritty. So what exactly is a gap? Well, this is actually a quote from inside the group when somebody else asked me, but it's not actually that relevant. It's like, do you need to know how an internal combustion engine works to be able to drive a car? No, you just press the right pedals at the right time. Well, here's my personal opinion. As internal liquidity, resting orders are assumed by traders trading them. It is both this and an imbalance or an inefficiency. It's all of these things, and it's just another name or just another term that's kind of irrelevant, okay? All we need to do is use these tools and determine a strategy, a direction, a plan, some sort of trading thesis, some sort of trading idea to help us determine our, our trade. So I use these as like an internal middle ground to determine whether we go to highs or whether we go to lows next. So just take this simple idea. If bear gap, expect external lows until proven otherwise. Proven otherwise equals the next section we're going to go on. So you can see here, prices formed a gap. You've got this real intention in price. See this really strong, large candle. Much, relatively speaking, it's much larger than the other candles around it. Real intention in price. Price rotates back into the internal liquidity and then back down to the external liquidity. So you've gone from internal to external. Okay. Now, inversions. Ooh, this is the wrong one. So, inversions are a core pillar of our overall strategy in terms of how we determine bias and enter a trade. Okay, so like many people learn the analysis side, they learn how to find key zones, and then they figure out an entry model later. For me, and what I'm going to teach you is I essentially teach you how to enter first. And I think that's how I've always taught it, and that's where I've seen the greatest success. We like start from the entry and then we're able to build out from there. So for instance here, inversions happen on every time frame and frequently, but it's important we don't just take every single inversion we see. We want the best ones. So you're going to see them all the time. You're going to see them on every time frame constantly, and it's about the trades you don't take. It's not about the trades you do take. Okay, so it's filtering out the shit and going for the good ones. And that's where the skill comes in and the experience. That's where you're able to determine what is a good inversion or what is an inversion you would trade, okay? Because you'll see them everywhere. And if you trade every single one, you'll probably make money for a little bit, but you'll also probably lose. So, it's a little bit 50-50 on that. So, starting out with some simple rules. When trading inversions, we're going to look for liquidity to be taken before considering an inversion trade. That is important. What is liquidity? We'll cover that in the next section. Stay with me for now. Second point, look for a single obvious gap. This is also very, very important, and it's what I'll cover next. We'll also be looking for momentum or intention. We're looking for, ideally, we want to see price moving with speed, with force. We really want to see the market trying to push in a certain direction. That gives us confidence in that trade, conviction. And then only enter on a candle close. So I'm going to go through that now. And the invalidation, of course, is if there's a close on the opposite side. So we'll go through this now. So single and obvious, whilst monitoring price, you will often see multiple gaps form during a leg in price. So you can see here, here's a leg in price, and we've got multiple gaps forming in a single leg. All right. The way that we reduce the noise and now find a gap that we can actually enter on and use for a trading idea is we will cycle up the time frames and we will find the single obvious gap. Okay, these are key words here. Okay, so a couple of words I want you to really remember: intention, single, and obvious. All right, they're key words. If we move up on the time frame, you can see that those multiple gaps now become a single gap. All right, so that's your single gap right there. Does this look single and obvious? By obvious, I just mean it jumps out on the chart. It's very clear to see from a quick glance. And a little trick, take a few steps back from your screen. Can you see the gap? If it's a no, well, it's not very obvious. This is why we do not use FVG indicators, whatever, gap indicators. We draw our own. We're training our mind, like I said. Next, we wait patiently on the same time frame that we identified the gap. So let's say, for instance, this was a 5-minute chart on a 5-minute gap. We would wait until the 5-minute candle closed above the bearish gap. Okay, so we're not trading shorts off of bear gaps, and we're not trading long off of bull gaps. We're longing inversions of bearish gaps, i.e. bullish inversion, and we're shorting inversions of bullish gaps, i.e. a bullish inversion. All right, so this would be your entry. Here's where you would enter, and you would target the next pivot or external liquidity. Okay, so what we've done is instead of going from internal to external and the bearish gap holding and we go into the low, when we get that inversion above the bearish gap, we're expecting the external high. Okay, so I'll talk about that more in a sec. But here's how you would enter, and that would be where you would TP. All right, and some of you may be looking at this and going, oh, that risk to reward's a bit crazy, isn't it? Yes, you're right. But we're able to use these on low enough time frames with a large enough time frame idea that the risk to reward suddenly becomes a lot greater. You know, if you were looking at the trade at the beginning I was taking, you know, it's suddenly expanded into a much, much greater trade. So important note, I use that. Well, an important note: there is no one best time frame to use for inversions. We are searching across multiple time frames, and we're looking for that single and obvious. Okay, say it with me: single and obvious. That is what you're looking for. All right. You search across the 5 minute all the way down to the 30-second. If you want to go down to the 30-second, go for it. I did just take a 30-second inversion trade today, so you know I've shown they work and they do work. So have a little play around those timeframes. Those tend to be my entry timeframes. All right. So next is the invalidation or the stop loss. So our invalidation is when we see a candle close to the other side of the gap. So for instance, here you've got a bullish gap. Don't know why it's not loading. So you got a bullish gap. You close below. You short. Stop at the high. I'll talk about that in a sec. But then you see the next candle closes above the bullish gap. That's what we would call our soft stop or invalidation, which means we manually close the trade after getting an invalidation. Although, as this is a soft stop, we can also decide to stick to our original plan and accept the risk of the hard stop. So the hard stop is always going to be the pivot high or the last high before you took that short inversion, as you can see from this image here. Okay. Although this is a soft stop, we can also decide to stick to our original plan and accept the risk of the hard stop. This decision will become more natural as you progress with experience. So, you know, the better you get at trading, the more you like the idea, you know, the more the setups that you see typically that you really like, and you can use your own sort of intuition with that. The hard stop means we are protecting ourselves from the potential of losing too much if price was to blast off. So you need to be using hard stops. And if you're just trading with soft stops, you know, you're letting yourself in with a bit more risk. So I've often seen inversions invalidated like this, and then price continue in the direction of the trade. So it's important you use your own discretion here. Usually I determine whether to close or not on how confident I am on the overall setup. Where are we delivering from? Okay, another key word, delivery. Where are we delivering from? Where do I believe price is headed? Have I traded a similar setup before? Have I got a level that's like super high probability, and I've got 90% probability levels in my repertoire? So, you know, I've got levels like that would potentially keep me from hitting that soft stop and would just tell me, right, stay in this, you're confident, stay. Am I happy with a hard stop risk? That's another thing. So like, if you've got like a fixed loss or fixed like risk percentage, like 1% or $200 or $500, whatever, like, just stick to that risk. If you're happy with the trade, then just stick to it. You know, if my stop loss got hit, would I be okay with that loss? And that's a really, really important question, because sometimes when you hit a stop loss, you can feel like, fuck, like, why did I do that? And that's how you know the trade wasn't actually that great, because when you do hit a stop loss and it feels okay, you know that it's just one of those losers on an overall picture, because no strategy is perfect. You're never going to win every single trade, okay? There's always going to be losers within strategies, and you know, it's important to accept those when they come along. So back onto the internal, external rotations. I touched on this in the previous section, obviously, but I'm going to expand on it a little bit more here. So it's very, 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 very important to understand this concept, as it forms the bedrock of our entire strategy. If we have a bullish gap, we expect price to react bullishly from it, bouncing. We should think that we should believe this. We should believe this until proven otherwise. Okay, so we're going with the flow of the market. Okay, we're going from internal to external. The market is constantly in this flowing state of internal to external, all right? We're going with the flow, internal, external. And we believe that. We believe that bullish gaps will hold until proven otherwise. So what is proven otherwise? Well, when an inversion occurs. So the internal liquidity acts as our bias mechanism. If it holds, we expect external high. If it inverts, we expect it into external low. Okay? So if a bull gap holds, you expect the highs. If the bull gap is lost, you expect the lows. All right? So now you can start to see how we're building up a sort of picture of price and where we believe it's headed next. All right? So we follow this simple mechanical rule, and it helps us with our decision making in the market. Next is another keyword that I asked you to memorize: delivery. So this is another crucial aspect of the inversion strategy. So we use this idea here and we couple it with lower time frame inversions. So for instance, we use higher time frame gaps such as 15-minute up to the 4-hour, in which we look for internal to external rotations as mentioned above. And then we use the lower time frames to help us get in. So here's a great example. Well, here's a great diagram. So in the delivery phase, you can see we've rotated down into internal liquidity. We then zoom in, and on the lower time frames, we find a bullish inversion. So we would find another single obvious gap, like a bearish gap like that. We would look for that to be inverted, and we would look to trade that overall higher time frame internal to external. Okay, so the lower time frame tells us to get in, higher time frame tells us the direction. Okay, so we want to see price react to internal liquidity and deliver from these zones, ideally from premium discount. You want discount longs, you want premium shorts. Zooming in, we want to see low time frame inversions as a sign that price may be beginning to rotate from internal to external. Here's an actual trade I took. Great example. You can see price comes up into the internal liquidity. There's a 15-minute gap. It goes above the 50%, so into the premium. And then I catch a inversion on the 3-minute. That is the exact entry I took. That is my exact stop loss. And that was my targets right there. I've gone from internal to external. All right. Now, the beauty of that, and something I'll talk about more in the future, is by trading internal to external, you're going with the flow of the market. You're following the trend. So instead of trying to catch highs and lows, reversals, you're much more likely to be able to catch, overall, far more likely to catch runners. Okay, so if you trade internal to external, there's a much higher chance that you're going to catch a runner. Okay, so you can see that 2R trade probably turn into 5 or 6R. All right. Whereas if you're trying to catch highs and lows, you're trying to catch reversals, maybe you catch 2 or 3, but the majority of the times you're just shorting into a trend. You know what I mean? It's not ideal. It's not what I would call easy mode. So premium discounts simply separated by 50% Fibonacci. I don't use any special fibs except for standard deviations, which I'll talk about in the future. But I only care about the 50% primarily. This just tells me buy low, sell high. Simple supply and demand. For a long trade setup, you want to look for inversions to take place when delivering from a bullish gap and a discount of a swing range. And vice versa. So finding the best inversion. So you typically find like what could be called like a signature in price. It's not quite a pattern, but it's like a signature. So like you're looking for a specific sort of makeup. Like no two situations are going to be identical, but there are certain signatures that you can find in price. So there's something called a V-shaped inversion that I've identified. So you can see here we bounced off this big 1 hour gap, and you can see that real obvious I think that's a 1 minute inversion, but you can see that really obvious gap that led into that high. Okay. This little white line here, for me, indicates liquidity. So it has run some sort of liquidity. It's entered this 1 hour gap. And then you've got this immediate strong inversion. You see this? So you go up, 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 and then bang down. Get that immediate close. That's your entry. Close on the enter on the close. Stop at the high. Strong V-shaped inversion. Sign of intention. Intention. Okay. Look what happened. Here we can see price show an immediate inversion or a fast V-shaped shift from bullish state into bearish state after delivering from a 1 hour bearish gap. The candle that closed below and completed the inversion was also relatively large compared to the other candles around it, we can use this information to determine that this is indeed a strong inversion setup and one we should act on with confidence. Okay. The other one that I've sort of patented as a pressure release inversion, I really, really like these. Essentially, you're looking for a nice obvious gap that creates pressure and holds price down like for a significant amount of time. And then when you see that eventual inversion here, it's almost like that pressure gets released and these guys tend to pop. Okay, so it's a really great example there. That's another type of inversion I really like. So I'm either looking for inversions that are very immediate and very obvious, or I'm looking for inversions that potentially build up a lot of liquidity, like people shorting bearish gaps. And then when you get that close above, people go, ugh, all right, I'm out. And you get all that buy side liquidity and there's boom, we fly. So technically, this is just a fight between supply and demand. And what you're looking to do is join the winning side. This pressure builds up inside the bearish gap, and the inversion is the signal to you that the bullish side has won in this example. The inversion provides you with a very simple mechanical rule to get in after the fighting has taken place, and that pressure can be released. So that was me motoring through fair value gaps, inversions, pretty much everything you need to know to get started, to be honest. I would highly recommend getting on your charts, drawing some boxes, figuring out exactly how, well, spotting the internal to external rotations. I'm going to show you some examples toward the end. But that is essentially everything you need to get started with me. And, you know, the more you do, the more reps you get in, the more experience you get with live market price, the more you do some back testing, you know, the quicker you're going to develop. So next, I'm going to cover liquidity. So the market is always hunting for liquidity. It is our job to find where it may potentially be sitting and to get in on the action. Okay, so I'm just going to quickly go over these couple of subjects in terms of liquidity, and I've already prepared a quick 10-minute video for you, so you can enjoy that. And I'll quickly have a sip of water and you can throw me some questions as well. But yeah, enjoy this. Hello and welcome to the liquidity module. So I'm going to be going over what exactly is liquidity and how we can use it to our advantage. Now, I'm sure many of you have experienced this, but you've gone long on a position, you've set your stop loss, it's looking good, and then bang, it takes your stop loss and then it runs. Okay, I'm going to talk about why this happens, and we're going to consider a couple of things. We're going to consider open interest, which is a simple concept that basically dictates for every buyer there must be a seller. It's a 1-to-1 ratio. Okay, and then what we'll also use as a framework, if you can't see the liquidity, you are the liquidity. Okay, now the best way to describe liquidity, or why it has any merit in our trading, and why we're not just trading from, you know, order blocks, Fibonacci's, fair value gaps in the middle of a internal range. You know, why are we not just trading from those and looking to get on the trend? Why does liquidity matter? Why should it matter? Well, if you want to catch the best moves and you want to be in the trade when the best moves happen, then you need to understand how liquidity works. So let's just imagine the order book. I don't read the order book personally. I'm going to present you a very simple observation of the order book, and this is just going to tell you why liquidity matters. Okay, so on the order book we've got a buy side and we've got a sell side. Okay, I'm going to ignore spreads for a second, so just bear with me. But let's say at $10 I want to fill 1,000 contracts. Okay, but as we know, for every buyer there must be a seller. Okay, let's just give that an equal sign so it's a little bit. Every buyer there must be a seller. Therefore, I need 1,000 contracts on the sell side. Okay, but what if there isn't another 1,000 contracts? What if there's only 100? Okay, what do you think's going to happen? Well, what will happen is essentially this 1,000 contracts will create a upwards move. Okay, by this I mean, let's say at 11 and 12 and maybe 13, there is an additional 300 up here. There's an additional 200 up here. And there's an additional 400 up here. Okay. So this all equals to 1,000. But I want to fill 1,000 at $10. What will happen is price will have to move up in order for me to have my order filled. Okay. Now you might be thinking, well, why are you trying to fill such a large order if there isn't enough liquidity? Well, that's exactly what we need to do, right? Because if there isn't sufficient liquidity, the big player who's got obviously a very important, well, a very large vested interest in getting his position in at 10 is going to experience slippage. And he will be filled at 13, okay? Because there isn't sufficient liquidity in order for him to fill his large position at $10. So instead of getting filled at 10, he's going to get filled at 13. And price is going to have to shoot up in order for him to have his order filled, okay? Does that make sense? So we're starting to get into the mind of large players, okay? So if I want to fill a very large order, I want to make a lot of money, I need to what's called engineer or induce liquidity, okay? And how can we do that? Well, we can do that by simply looking to push price below lows or above highs, okay? Because what happens above highs and lows? Let's consider that. Well, in the example that we had before, we have a long, okay? So I currently am buy side, okay? I'm buy side. But if my stop loss is below and the price comes and hits my stop loss, what do I now become? So I was +1, and then that'll be now -1, and I will be at 0, okay? So this is selling liquidity, all right? This is also known as sell side liquidity. So below lows, there is sell side liquidity. Because if I'm in a long position and we hit the stop loss, I have to sell. Okay? So if I have 1,000 contracts I want to fill, and at $10, there isn't enough liquidity on the opposing side, let's say there's 500 this time, but we push price below into $9, and then suddenly the liquidity jumps up another 500. Well, I'm able to now fill my order at an even better price. Okay, so essentially, this is by the way, this is a very, very simplistic view. People who are very, very proficient with the order book will probably shout at me for a bunch of this stuff, but I'm just using a very simplistic concept to demonstrate what I'm talking about. But essentially, yeah, that's what will happen. When we go below lows, we will generate sell side liquidity. Therefore, larger players will be able to fill larger positions. Therefore, they'll be able to move the market in a bigger move. Okay, so that is what happens below lows, and the exact opposite happens above highs. So if I'm in a short position, I've got my stop loss above highs. If I'm in a sell, I'm in a short. What happens when we go above the high? Well, we create buy side liquidity, because I will have to buy, my stop loss will buy to get out my short. It'll be from a -1 into a +1 into 0, of course. And that creates buy side liquidity. Okay, so let's just break that down again. in order for large players, big bosses, big fatties like this, in order for those guys to fill large positions and make a lot of money and get the best price they possibly can to avoid slippage, like we talked about before, to avoid slippage, they will naturally look to move price above highs in order to sell, and they will, where obviously buy side liquidity is generated, and they will look to move price below lows in order to generate sell side liquidity in which they would like to buy so they can fill their big fat positions. Okay, so that is essentially why we need to be considering liquidity, because if we want to catch the best moves, we need to see the liquidity. We don't want to become the liquidity. Okay, remember that. If you can't see the liquidity, you are the liquidity. All right. So that's a very, very important concept, and one that we're going to be using throughout. We want to see lows taken, we want to see highs taken before we even consider a position, because if we are going to trade with the big guys, which is a very, an advisable thing to do, we want to trade with the smart money, as it's called, and we don't want to be that dumb money. We need to make sure that we are no longer viewing highs and lows as just highs and lows. We are considering the liquidity above and below. Okay? So that's just the introduction to liquidity. I hope that makes sense. Rewatch it if you need to. This, again, is a very, very simplistic idea of the order book. Obviously, it's a lot more complex than how I'm discussing it, but the concept is the same throughout, and we will see that through the rest of the course. Okay, so that is essentially how I understand liquidity. All right, and if any of you in here right now are thinking, what the fuck, that, like, I know the DOM, I use it every day, I'm very proficient at the DOM, and that was complete bullshit. It's like, dude, I don't care. Like, this is how I understand liquidity, and it works for me. So just in summary, we predict stop losses below lows. We define that as sell side liquidity. We predict stop losses above highs. We call that buy side liquidity. Okay, you're going to have the assumption that large players have a vested interest of getting the best price for their larger positions, in which they can extract the most money out of the market. The sad part is you are whale food unless you begin to understand how they play the game. Smart money versus dumb money. Another aspect of this is dumb money or breakout traders. These traders will typically trade emotionally and look to short below lows and long above highs as they see the opportunity for a potential breakout. So that's just how I personally see liquidity. Next, I'm going to quickly gloss over time-based liquidity. So this is another thing that is important to understand whilst you are, engaging with me in these trading rooms. But essentially, I see time-based liquidity as a high or a low within a certain time window. So for example, you've got a day. So what was the high of the day? What was the low of the day of the previous day? So now you can use those highs and lows as a form of liquidity. Okay, so they are time-based liquidity. Sessions, I also use Asia, London, and New York sessions. Okay, so you can see here we've got Asia high taken out in London. It then runs Asia low, and then you've got New York that takes out London lows, etc. So these are very, very important things. And that's essentially all we need to talk about, really, in terms of liquidity. I use these areas as potential areas of interest, and yeah, that's pretty much all we need to do now. So we'll move on to the actual charts, and I'll talk about gap theory. So gap theory is something I sort of coined as just high time frame inversions. So I like to call it gap theory, but essentially what we're doing is we're using higher time frame inversions to give us a bias. Okay, so we use the lower time frame inversions for entries, but we can also use the higher time frames for bias. So I've got a few examples I can run through. So let me just get rid of this. So here on the 7th, you can see what have we got here. This is a 4-hour gap. It was inverted here. So that told you at that candle close that in the next 4-hour candle or the preceding 4-hour candles, you are likely to come and run this high. Okay, you can see it did it in an immediate fashion in this one. Okay, what you've also got is over to the left, you've got, this is a bit messy because it happens around a weekend, but you can see that this one didn't close until eventually this candle here, and that told you that you were going to go and get that high. So you're using the internal liquidity, you're using the high time frame inversions to tell you your bias. Okay, so this is on a 4-hour scale, tells you that you're likely to go up. So what you're able to do is use that higher time frame bias to find lower time frame entries in order to follow that higher time frame bias and get the trade in that right direction. So that is essentially what I call gap theory. I'm going to go through a few more examples here, and then I'll open questions up. So that was a couple of examples there. High time frame inversion here. So I'll do this on a. Where's that gone? There it is. So here's a cool example. Here you can see this high. So this is a daily time frame. And here's an example of where you get that invalidation, but it still works out. And I'll show you how it works out using lower time frames as well. So you can see here, there was a daily gap. You get that inversion of the lows there. That signals that potentially this high has reached its peak. And if we go down onto the 12-hour, you can start to see where the internal liquidity and external liquidity starts to happen. So you create that inversion here. You got internal, external, internal, external, internal, external. Okay, so you can see that flow of price, and at this point you get your confirmation. It happens really clearly. Like, it's very, very clear to see it, this on the 12-hour. Like, it's very, very obvious. Okay, you get that inversion there on the 12-hour. It comes up into internal liquidity, external, internal liquidity, external, internal liquidity, external. Like, it's very, very obvious. Obviously, these aren't completely bulletproof, like every strategy. That are obviously obvious failings. So I'll find a failed one on the 11th of October. So it was actually today, this one. So here you can see, did it run that low? Yeah, so it ran that low. You got a 5-minute inversion here, but then price began to move back down. Okay, so this was a failed inversion. This would be arguably your first pivot, and this would be your next major pivot. So you can see you get that inversion, but price fails. Got another few examples. On the 4th, there was a high time frame inversion. Yep, this was a nice one. So you can see here, you've got a 1-hour gap right there. You lose it here. Okay, that gives you your bias down towards these lows, these pivots. You then move up into the 4-hour, and you can see that internal liquidity there. So it's gone and given you the bias from the high. So the high has come up. It's shown weakness. So a bit like, you know, not quite a market structure shift or anything like that. You're just using a simple box to tell you that this has now been lost. This is a sign of weakness. We're expecting external lows, pivot lows, because the bullish gap has not been held. If this bullish gap was to have held, we would have expected external highs, but we were proven otherwise. We were proven otherwise when we had that inversion of that low right there, and you can see price then rotates back into this internal liquidity here on the 4-hour, and it simply just goes internal, external. Okay. So we got any others? Oh, this was a really, really nice one. This was actually a low I was watching for a while. So you can see here, and here's a nice little, so you can see there was a daily gap here, and there was a nice 12-hour there. Oh, there it was. I actually marked that wrong. There it is. So you can see here, there's a daily gap, took some nice liquidity, and you came down into this discount here, and you took this liquidity here. That was a low that I was looking at. Literally, like, this is all on video. Like, I was talking about this entire way down. I was like, I really, really like these lows, and you can see that was the launch pad there. Reason I liked it was because you've got this wick inside of this gap here. So I really, really like these. This is a nice little Easter egg for you. So when you've seen price do this, where you form this gap and then you have this tap and go kind of thing, this creates this liquidity here, and there lies a lot of liquidity. Okay, so when you see a gap form, see a wick inside of it, when price comes back down and reacts to that wick, you tend to get some really nice reactions, and it tends to be a really, really key liquidity zone. So this was a really, really nice reaction. It was the level I was watching personally. You can even see there, just notice there's an inversion right there on the 12-hour. So, you know, the 12-hour is actually really, really clean because it gives you a little bit more granularity from the daily. And not a lot of people use it because I think it requires premium. But you can see here, price comes down into the discount, reacts from this wick down here onto this large gap here, and you get a nice inversion there. That tells you that this has been a strong bounce. And at that point, you could have gone all in on equities and stocks, and eventually you've shot off. So really, really nice. So just looking at the price action right now, you can see that what's being held. Currently holding this bullish gap here. So if this gets lost, we'll start to expect this low down here and this naked gap. So this gap hasn't been tapped. This 12-hour down here. And you can see that it also lines up nicely with a discount. So here's where I would love to do some business. So I think that's the majority of my examples. I don't want to go into too much detail. I wanted to make this quite quick. I understand I've gone very, very fast. Well, you know, I had a lot of ground to cover and I didn't want to make this too long. I've already nearly reached the hour mark. So if anybody's got an example, please do ask now. I'll just show you some more examples of like different trades I've taken recently. So like for instance, here, this was London Open. You can see that price came down at London Open. You then have this internal liquidity here. So you've gone from internal. So you're expecting internal to external. When are you expecting it? Well, when you get your entry confirmation. So here would have been your entry. Right here on that candle close. So you've come up into internal liquidity. You've got premium discount right there. So you've entered, tapped into the 618, 0.5, the nice premium pricing. You've had this bullish gap form and you close below. So now you're expecting with pretty high confidence that you're going to hit this external low. Okay. And another trade I'll talk about, this juicy one that I caught yesterday. So this is a really, really nice one. You can see this on the 3 minute, or was it 2? Yeah, it was the 2, wasn't it? So this is the trade that you would have seen me take yesterday. You can see that you've got this huge wick from CPI's news release, and these act as great draws on liquidity. I'll cover that in a future video. But you can see how great this trade was. You've come down and you've done this like consolidation. You've ran the liquidity, okay? Filled a bunch of that liquidity, and then what have you got? This nice strong V-shape inversion. You've closed above the gap. There's your entry, and then you've formed a gap there on the leg, and that bullish gap's held like that. You can see the evidence strength in this price. All right. Now this is a kind of scenario where this is like where you wouldn't be taking every single inversion you see, like I've mentioned earlier on, but using just your overall plan and sticking to it. So like this is where I entered and this is where I was holding. I was long and I had a target and I was holding out to there. Okay, I did take profits along the way, but I wasn't planning on shorting this one. I wasn't planning on shorting this one, and you could have even long that one, but I wouldn't have planned on doing that either. So if it lost that gap, then you consider closing out early. So example, yeah, perfect question. So you've got this inversion right here, and if this bullish gap here was lost, that would tell me that the market has shown weakness. All right, so if I'm in a long, do you think I want to see the market showing weakness? Well, the obvious answer is no. So if we did close out below here, I would consider closing, but in this example, I've got a very, very confident setup I've seen play out so many times. I'm sure Spitty's seen this a lot as well, but when you see these abnormal wicks on a news release, and abnormal, you can see, look at the size of it in comparison to the other candles. These act as really, really great magnets for price, or what I call a draw on liquidity. So I was happy with my stop at the low. I had, on my 100K account, I had $500 risk, and I made 1,200 when we hit that level. So, you know, it was more than a 1R trade. More than a 2R trade. So very, very happy with that. See what other examples I've got, but you know, if you just spend some time with me in the trading rooms, or you watch the content back, you'll see like a lot of these core concepts I'm just constantly talking about. See what else I've got in here. 1 minute. Manipulation, like conversion. Where did I do that? I don't even know where the hell that is. No, completely lost that. Oh, there it is. Ah, perfect. Okay. Lovely. So this is another great example, similar to the one I just showed you with the news one. But look at this. You've got this accumulation, this like ranging around. Then you've got price run for liquidity. And then instead of just shorting at highs because you think that's, you know, that's the right thing to do because there's liquidity there, you know, more often than not, you're going to probably just get fucked and it'll keep going. But when you have a clear, obvious gap like this and a clear, obvious manipulation, when you get that close below, that is your entry signal that this indeed was a manipulation. Okay, so what you're doing is you're looking for price to manipulate liquidity, draw in those stupid, dumb money like buyers and all that buy side liquidity for the early shorts, fill your bags, get all that liquidity, get your entry model confirmation, and then you can run it. Okay, so absolutely beautiful trade. And yeah, I think I'll probably leave it there, to be honest, because we're about to hit the hour mark. Like I said, I know I've done this really, really quickly, but I had a lot of ground to cover, and I wanted this to be the foundation that people can use to be able to join me in the trading rooms and start to actually get an idea of what I'm doing. So then in the next lessons, we can go in more specific concepts and talk about some of the more advanced things. How I determine, you know, draws and liquidity, how I use like standard deviations, how, you know, little tips and tricks and things like divergences, all that kind of fun stuff. So yeah, that's about it. I hope you've enjoyed. Watch it back a million times if you need to. Put it on half speed. I know I'm speaking pretty quickly, but you know, I'm not going to apologize anymore. And I think my long has officially been stopped. Yeah, so we made 776 on that long. Happy days. All right, peace out. Catch you later. Bye.